Hey traders, this is Blake Morrow with Trader Summit, and I have Mr. Jim Welsh with us from Macro Tides. He's joining us to tell us why the hell NDVA is just ripping and taking this market into all-time highs. What's happening, Jim? Good to see you.
Yeah, it's great to see you, Blake. This is a unique situation, obviously, where so many, positive things are coming together, and NVIDIA is really at the forefront. And again, are things going to get mispriced? Of course they are, because that's what happens when you have such unanimity about anything. Everybody wants to get a piece of that action. At some point in time, NVIDIA will lose half of its value.
Yeah.
We should write this down so that you can, a year from now or so, you can say, "Oh, Jim, NVIDIA is up like another 50%, and you said it was going to lose half of its value, and I'll put some mud on my face."
Well, you know what? Maybe that might be the title of today's video. NVIDIA will lose half of its value. That'll spark some interest.
Yeah,
But
yeah.
no,
Who is this idiot?
jokes aside,
Yeah,
you've been around long enough, Jim, and
yeah,
we've seen this song and dance before. We are
yep,
in now. You don't know how deep into this baseball game, that we're in. If you want
right,
to use a baseball analogy, you don't know if we're in
sure,
the ninth inning, the seventh inning, maybe even in the third inning of a nine inning
yeah,
game.
yeah,
But at this time, there is a lot of FOMO out there, and the market is chasing yield, and they're just looking to get what they can get. And right now, I
yeah,
mean, equities are not very far off of all-time highs. We've spent this whole week consolidating at all-time highs, and I'm interested
yeah.
to find out here shortly if you think that we can get there. But
Yes,
before we
yes,
do
we
that,
can. Yeah.
what's
All right,
that?
let's briefly interrupt this program to
Yeah,
talk
yeah.
about
No,
other
I just
stuff.
say before I do that, and I jump into some of the
Yeah,
charts that you brought. I
yeah,
just want to say if you like our weekly meetup that Jim does here with myself, but for the Trader Summit community, make sure you give him a thumbs up, subscribe to the channel. Make sure you reach out to him just for his the latest technical review that he has, and he'll shoot that out to you, right, Jim?
yep, absolutely. Jim Welsh Macro at Gmail, baby, and
All
I'll
right.
send it up.
Well, get those emails out, especially as we head into the Memorial Day weekend. You're going to have a long 3-day weekend to digest that information. So make sure you do so. But the first chart you brought for us, Jim, is you brought we had a ton of Fed members
Yep.
that spoke this week. And what was your takeaway?
Well, not really that different. Basically, this chart is created by J.P. Morgan, and they determine of all the speeches, are they leaning hawkish or dovish? And the interesting thing is, it tracks with what the Fed did with interest rates pretty closely, in the sense that in 2019, in mid 2019, the Fed did cut the funds rate. And then as we saw going into 2022, the talk turned more hawkish, and the Fed surprised people by increasing the funds rate more than anybody expected. Remember, beginning of 2022, Goldman Sachs was looking for 3 rate increases in all the year, each being a 25 basis point increase, and the Fed surprised everybody with successive increases at every single meeting that year, with a total of 3% between the June, July, and September and November meetings in 2022. So, point being, though, is looking at this, it's not declining, it's not near zero. So, this is reflecting what we heard in, I think, most of the speeches, in that they need more confidence, which is something that has been said for months. You and I have talked about it, and that recent data, back in February and March, I said, we're going to get CPI data that is not going to give them the confidence. That's what happened. And yeah, the last month's CPI was a little bit better, but it's not going to turn the tide in terms of changing their outlook in terms of, oh, when should we start cutting rates? Interestingly, I think yesterday, Goldman Sachs, which had been kind of pounding on the table, that they're going to cut in June. Well, they pushed it back to July. So the other thing that came out this week were the minutes from the prior meeting on May 1st. And some people want to discount them because, well, they were 3 weeks old. Again, we're at a point in time, Blake, where I think you have to get into those minutes to, if you will, understand the mindset of the FOMC members as well as kind of the groupthink that's going on. And in those minutes, there was conversations that a number of people brought up. Well, we have to be open to the possibility of increasing the funds rate. Now, I don't think the Fed's going to be increasing the funds rate anytime soon, but the idea that they're entertaining rate cuts, the potential for it, well, certainly throws some cold water on there being a race to the Fed cutting rates.
Right.
Aggressively.
Exactly. And I was going to ask you this question. Maybe it's best for your next slide before I ask it, but maybe you can address this. In your view, the next move by the Fed will be blank. What do you think?
Cut.
You still think it'll be cut?
Oh, absolutely.
Okay.
Now, again, I'm in the minority because I think the cut is going to come not because inflation has worked its way down enough. I think the cut is going to come because the economy is going to slow more than everybody expects.
Yeah.
And, that's the rationale.
Okay. Well, the next chart that you brought is the Fed neutral rate. And explain to us what the neutral rate is.
Well, basically, it's the rate where it's neither stimulative nor restrictive. It's like right perfectly in the middle. And the reason why this is somewhat pertinent is, in effect, the conversation that they had at the last meeting was, maybe we're not restrictive enough. As you know, they've been saying for months and months, we've got the funds rate up to a restrictive level. And the idea being we're not going to increase it from here. We're just going to hold it here higher for longer because we're at a restrictive level. It will eventually have an impact on the economy by slowing it down. So again, this is just showing the basis for that conversation. And, I think, is the funds rate modestly restrictive? Yes. Are they going to hike it from here? I don't believe so. It is higher for longer until we get real evidence that the economy is slowing down. And they're not going to react, I think, at the first signs of slowing, because in all likelihood, the economy is held up well for a lot of different reasons we've discussed. And I just don't think it's going to be like a light switch. Somebody turned out the lights and the economy's tanking. I think as it rolls over, the slowing is going to be very gradual before we start to see a meaningful uptick in the unemployment rate. And it's at that point that the Fed, I think, will respond.
Okay, well, let's see if they will indeed respond. The next chart you brought was regarding services inflation. Now, we had a University of Michigan consumer sentiment, come out today. Sentiment came in stronger, and inflation expectations actually dropped, and so that's pretty soft landing-ish data, right?
Yeah. Now, just as an aside, I don't personally put much weight on the inflation expectations in the University of Michigan report because they're out like 1, 3, 5 year. The average consumer, I don't think, really is in tune with any of that kind of stuff, but the Fed does pay attention to it.
I took 43 robocalls that actually addressed that survey 43 different times myself this week. So
are you kidding?
Just kidding. I'm not joking.
See, there's a sucker born every minute, and I think I'm a newborn.
Sorry, did not mean to throw you off. Okay, anyway, tell us.
No, that was perfect. That's good. It's Friday. We're a little daffy, and I'm waiting for the duck. Anyway, so everyone's talking about owner's equivalent rent and rent inflation coming down, and boy, that's going to suppress the PCE and suppress the CPI. Yes, it is. But what's happening underneath the surface is inflation, ex-shelter inflation, as we can see, is going in the wrong direction. So it's offsetting the decline that's gradually working its way into the numbers from shelter inflation unwinding. So again, this is just the Fed in the minutes and in some speeches this week, they specifically talked about service inflation. And so to me, this chart is relevant, obviously, because it kind of shows that everyone's, oh, yeah, inflation is just overblown and shelter, it's going to come down, blah, blah, blah. Well, yes, but this is saying there's other forms of inflation that are happening that are deteriorating, relative to what expectations are. So.
All right. Well, let's continue on then, because a PCE, by the way, is this next week.
Yes.
Okay.
Yes.
Just
And
make
I'm
sure.
sorry, I forgot to really look at that and come up with numbers. I'm trying to remember. I'd have to look, Blake. I don't think there's going to be a big change. All right.
Okay.
Whether it's, I think it can downtick, I think a tenth, because I'm trying to remember what the takeaway was, and I can't remember it. But going back to of April of last year. So I think the PCE is going to be a non-event in that it's not going to be definitive one way or the other. It may downtick a tenth. Is that good news? Yeah. It's not going to, again, sway the Fed into, okay, now we can cut the funds rate. All right. Onward and upward.
All right. All right. Well, this is an interesting chart, because this is where a lot of people are seeing premiums go up. So
yeah, well, think about it. House prices went up by 40% in the last few years.
Yep.
Car prices went up, I think, probably about 30 to 40%. And so all the technology on cars means you have a back end, a bumper, fender bumper or whatever. It's going to cost you a chunk of money because of the technology that now embedded in cars.
Tell me about it. I've got a teenager that got in an accident. Yes, understood.
Okay. Yeah. So, right, can I donate an arm? So anyway, so this is some of the service inflation that's feeding into that pipeline. What has real world requirements in the sense that it's just reflecting the big increase we've seen in home prices and car prices and used car prices. And so this is where we're at, folks. This is a very lagging indicator in the sense that car prices went nuts 12, 18 months ago or so. And now the insurance companies are kind of, making up for it.
And these are things that we as consumers, we can't get away from. I mean, you have to have auto insurance. You have to have home insurance.
Yeah.
You have
Unless
to be able
you're
to
in this country illegally, but I shouldn't probably say that.
Yeah,
but I do live in California, and there are a lot of people that drive around in California that don't have insurance. In part, it is so expensive. And so to your point, like, people are being forced to make choices. Food on the table, paying the rent, or gee, if I drive really slowly, maybe I won't have an accident. And so I'm going to stop paying my car insurance. I'm not going to carry it.
That is not legal, folks.
Life for some people.
That is not legal. Let's just make sure we clarify that. All right.
It is not legal.
All right.
So,
all right. Well, how does all this information translate into what you're seeing in the markets? Because this week, like I said, stocks have rallied. Dollars still kind of range bound. As a matter of fact, let's get into your dollar chart.
Yeah.
It looks like we're smack dab in the middle of, that's pretty much what I'm seeing too, Jim. A big fat triangle, and we're just in the apex of it right now.
Yeah, and we're working through it. And my take here is that the dollar will drop to test that lower trend line, which is probably around 103.50-ish. And as I said, up at the top there, 2 legs down equal would be a 103.74. So if and when we get down to near that area, to me, that will invite potentially a larger bounce. But ultimately, if this indeed is a triangle, the dollar will break that first trend line after a bounce and then drop down and toward the trend line that's just above the D letter. And that's when a larger bounce that takes more time for wave E. Now, again, this pattern implies that once you finish this triangle, A, B, C, D, E, the next leg is a big decline.
Okay.
And,
all right.
That's my view. And again, it's shaped by the expectation that the economy in the second half of this year is going to slow more than expected, which obviously will invite rate cuts by the Fed, and I think that will undermine the dollar.
Which, I just want to go ahead and stop here for a second, and we're going to get back into Jim's charts. Jim, you make these predictions, or you can call it a base case based on the analysis that you're doing, but it can change. I mean, and things do change.
Yep.
We get inputs that come in, and you're like, shoot, I got to shift gears. And I thought I was going to go that direction. Now I have to go that direction. But that's part of trading and investing. And I think one of the things, and I'd like to get your feedback here, but one of the big mistakes that I see traders do and have for decades now is they get so entrenched into their bias that they're like, I know I'm right, I'm not wrong, and they'll have to fight that bias and fight their P&L going negative for a long period of time without being open-minded and just understanding that, hey, we get things wrong from time to time. That's part of what we do in trading, right?
Yeah. Let's face it, this is hard.
Yeah.
This isn't easy, all right? Number one. And you're 100% right. What I've learned over time is I can have an opinion about something. And one of the things I had to learn or unlearn and undo is the tendency, well, I just want to find information that supports my point of view. So like in this case, I think the economy is going to slow more than expected. All right. And if I wanted to have blinders on, that means I'm going to ignore any piece of information that contradicts that. And that's the box that we all get into, human nature. We want to find justification for a position. That to me is why technical analysis can be so helpful, because it's good to have an idea, but moving averages, chart patterns, and so forth change the whole thing. So, I think the economy is going to slow. I think the dollar is going to weaken significantly. Yeah, but if the dollar starts to rally and gets above the prior high at 107 and change, then I'm wrong in all likelihood. And that to me is where the balance between fundamental analysis and technical analysis can be really, really helpful. Because if I'm just basing it, most people follow fundamental analysis, and I'd say in your community, most people follow, for the most part, technical analysis. That's why, to me, the blend of both is helpful, so that one checks the other, and so that, I can be wrong. I've proven that. Hopefully I don't stay wrong.
Yeah,
and I think what you just said is a really, really, people have to have the self-awareness of, our egos don't matter.
Yeah, the humility, right? That's part of it.
And this is really hard to do this.
Right.
It is.
Right. It is. Well, let's what's not so hard is just being long gold and just staying long gold. I mean, come on. But this chart, Jim, it suggests that we might have something else going on, right?
Well, last Friday it was like, hey, we're going above 24.27. Sunday night they traded up to 24.49, and you had this big reversal. And what I discussed in the Monday weekly technical review is, if you go back the last 6 months or so, you had a key reversal or big reversal on December 4th, April 12th. Both those times led to corrections that lasted a while and retraced more than what I think we've seen. So my take would be is, we got down to that trend line, a bounce, and then I think there's more probing that will likely take place, with the potential of gold trading below 22.81. Once this is done, this corrective move, my bias is we're going to see another rally that's going to take gold higher. So, to me, the trend is still up. Short term, that reversal, like it did the other two instances, suggests that there's more correcting to be done. All of a sudden on CNBC, these tiny little gold companies are advertising. We have this much in reserve. It's like, okay, we're at the stage where obviously a lot of people are becoming positive gold. Yeah, and that's why the ads are starting to show up.
Right, exactly. Well, Jim, what is it going to do for the bond market? I mean, you've been Looking at TLT the last couple
Yeah.
months, you really called this bounce here, but what do we do here? Because I mean, we are just been going sideways really the
Yeah,
last.
yeah, yeah.
So
Well, the take was that you have five up, so we were going to see a pullback.
yeah,
I believe in the bigger picture that the correction that began in late December ended a few weeks ago, and that we're beginning wave C that's going to take TLT above 100, I think up to 105, 109, and that five waves up was wave one of C, and we're in wave two of C. And, as the numbers show, a 50% retracement is what, 88, 88. Wave four of lesser degree is right near there too. So to me, it's kind of like you want to buy this pullback because I think what follows is a fairly significant move to the upside.
okay,
And
well,
what would predicate that? Obviously, the economy slowing more than expected, or potentially some kind of geopolitical event.
we'll see if any of those two manifest. As of right now, people that have been looking for a slower economy, it's been kind of not off base, off sides for a while, but there might be one coming.
Yeah. Well, that's, as you know, that's my view is
Yep.
that if you look at longer term indicators, we're going to see the economy slow as we get into the second half of this year. I think slow more than expected. All right.
Yep.
So last week when we talked about the S&P, I
Yep.
thought that wave three had ended at 53.25 and we were going to have a pullback. And the two targets were 52.50, which was where gap was on the prior, on the CPI report, and a 382 retracement down to 52.05. So it got to 52.57. So, there's two patterns here. Either the wave three didn't end at 53.25, it ended at 53.42, or more likely is you had an A down, B up to 53.42, C down to 52.57. And for wave four of five, my expectation is that there's going to be another rally. Same thing as last week. Hey, we're going to have a pullback and then we're going to have another move up. The target is 53.90. And how I get that target is, well, what was the length of wave one? Because frequently wave one and five will be pretty similar in length. And 133 points for wave one added to the low we saw yesterday at 52.57 gets you 53.90. Now, I think this is going to complete something. And we're going to see a bigger pullback after this final push up here. And the next chart will explain why I have that view. And basically, it's looking at the number of stocks that are making new highs and new lows. And this is a 21-day net average of highs minus lows. And what we can see is the most recent high that was hit in the last handful of days. The high-low indicator is not confirming it. And it broke below its moving average yesterday. So to me, these are signs that, all right, the pattern suggests we got another push coming for a wave five, but the internals are starting to show more weakness. So that's why I think, Blake, if indeed another rally takes place, you get above 53.60 to 53.90, that is going to mark kind of at least a short-term high with a pullback probably to 49.54 being in the as one of the targets that one would come up with. Once we finish the leg up, then we can do more calculations like 41.04 up to, let's say it is 43.90. What kind of a pullback should that engender? Pardon me, 53.90. So I think potentially this last leg is completing the rally from last October.
Well,
And
that means that theoretically we have a more of a rally to go next week, and maybe next week is where you sell into strength.
that would be my bias. Yeah, basically, I've told people I think it's time to start selling above 5,300 because I think we're going to have some kind of a pullback. I think it could be a little deeper. If that is right, that we're finishing something here at 5,300 from 4,100, 1,200 points, 382 retracements, what, 400 points almost?
Yeah.
So we're talking about, as I said, the initial target, that 49.54, wave 4 of lesser degree, becomes one of the targets. So if the economy suddenly 60, 90 days from now starts showing more signs of slowing, well, all of a sudden you start off at a normal correction and then something more severe developed. There's no way of knowing that. That is coming. Is it going to come in June and July or August? I don't know.
Yeah. Hey, Jim, I got a question for you. I was talking to one of the traders in our community, was saying, hey, there might be a surprise. There could be a surprise Fed rate cut. And I thought about that for a bit. And I was thinking, surprise meaning, let's just call it June, this next month, we get a surprise rate cut. No one's expecting it. We get it. Now the one of our traders was saying, well, and I agree, if the Fed starts cutting rates, a lot of economists believe that they're going to be doing it because the economy is slowing. So therefore the stock market's actually a sell at that point. If the Fed surprised us with a rate cut, my view would be that they did it to get ahead of the political environment because they know they wanted to do it to get us back to neutral, but they don't want to look political. So they're doing it now to get it out of the way before November. So they are not viewed as political. But if that happens, I believe the market would actually rally, and then you sell into it because you believe that, okay, they're doing it to avoid being political. Let the market rally because it's going to go, oh my God, we got a rate cut. Why did it happen? But I don't think the market's going to be going down because the Fed's doing it because of a slowing economy. I think the market would actually be going down because people would say, oh shoot, they did it early. Now we have nothing to look forward to the remainder of the year. That would be my view. Do you have any opinions on that? Because I thought it was a great comment from one of our very astute.
Sure.
By the way, I've met this investor. He's been with me for probably a dozen years at least. We met in person before, and he's very thoughtful and insightful in his thinking. So I thought it was a great question. What say you in that situation?
I'll use the initials NFW, and I'll let people decide what that really means. The probability, I think, is remote at best. Because I think, again, I'm going to take Jay Powell at his words. And in his mind, the Fed is going to do everything it possibly can to keep their eye on the ball, and politics isn't on that ball. And so I think the odds of them cutting the funds rate at the June meeting is, nothing is ever 0%, but I think it's a really low probability. To your point, if they did in fact cut, and they're cutting not because the economy is forcing them to cut, would the market rally? I think you're right. Because historically, the market has declined and is experienced some big sell-offs when the Fed is cutting because the economy is lousy. Okay, so that's not what's happening at this point in time, and not likely to happen between now and June.
Right. And so, okay. All right. And so NFW, no farting on Wednesdays. I've been trying to figure out what that acronym would stand for. And I guess that's it. That means don't eat beans on Tuesday. So there's no farting on Wednesday. Guys, gals,
that would be NFOW, but anyway.
Hey, if you enjoy these interviews that we do with Jim, make sure you jump down in the comments. Tell us what you think would happen if the Fed gave us a surprise cut, and is it really no farting on Wednesdays? Jim, I want to thank you for being with us every week and providing your insights. Make sure you guys and gals check out macrotides.com. He happens to live in Southern California, and I get because he's macro tides by the anyway. Jim, thank you so much for spending your time with us. I really appreciate you. And have a great 3-day weekend. Enjoy Memorial Day, and we'll see you next Friday.
Thanks so much, Blake. Have a great weekend.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.